Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain. Thanks for joining us.
Glad we are here. We are broadcasting on the 15th of June, and
yes, interesting.
The year's about half over.
Interesting.
What's interesting?
Well, the political environment is interesting.
We don't talk about politics in this program.
Oh, we don't have to take a side here. I think that we could all agree that the whole...
That is correct, yes.
Right.
And troublesome.
Oh, extremely.
Yeah.
Extremely.
Yeah, any right-minded person would say.
I would hope.
Not right-minded, politically right-minded.
Just correct.
Yeah. They're intellectually honest.
Yes.
Anyway, but here we find ourselves.
Yes, and we're here, and the markets march forward, and the economy still runs, and we still get up in the morning and go to work, and this too shall pass, and children are born, and people graduate from high school and go on to college or get jobs. It's an interesting time.
And with yet the markets, it's really interesting watching a couple of these stocks.
Yes.
NVIDIA.
Oh, correct. Which is
who even heard of 2 years ago?
And it's been around for quite some time.
Like 20, 30 years, something like that,
yes,
right? It's a long time.
And now has a market cap, what?
Yeah, the leader, the CEO, is no young I mean, he was young when he started the company, but that was a long time ago, and now he's an old dude.
Yes.
And yet the stock hit over $3 trillion in market cap.
Which is a big number. I don't care where you grew up. That is a large numbers market cap.
And I find that interesting because you obviously, AI is the buzzword for everything right now, right? So if it's AI and what are you guys doing for AI? Oh, well, let me tell you, right? Everything.
Or like the .com was in
and obviously
98.
It's going to have implications and things that we don't even realize at this point.
Correct.
We don't even see.
That's right.
I mean, you think about how the iPhone has changed all of our lives.
Yeah, but AI has been in some form and fashion. Not just big data AI is what has really changed. AI itself.
Yeah.
The mere fact that you could go to Netflix and it will recommend things to you is a form of
course,
AI,
yes.
But it's just small data sets. Well, it's relatively small.
But what I find fascinating is you look at how much energy it's going to. I mean, already now, if you look at the amount of energy servers and stuff take data centers, it's phenomenal. But the energy here is exponential. And there's already a lot of people stating that there's not going to be enough power.
So
and tech companies are going to start buying power plants
because they have no choice. So
the thing I question, I'm no analyst, but if you look at NVIDIA is priced for growth, right? It's not priced for, obviously, the revenues have gone up dramatically as companies like, we don't want to be left behind. We better get in on this. And
the revenue grows.
Yeah, so they send an NVIDIA check for some services and products. But I kind of question, like, if the AI boom is as large as some people are believing it is, what's that going to do to our power situation?
It's already started. So the utilization of the existing infrastructure has already started by using smart technology to actually decide where energy should be routed and how it should be used. Read an article last week where now if you have an electric vehicle, they're doing trials. I think it was in Vermont or Massachusetts, somewhere where the car companies themselves will actually give you a discount of the car as long as you actually plug it into a two-way, which means that they can draw your battery down at certain points in time. Right? And
you see where this is coming. The government's going to mandate you to own an electric car, and then it's going to mandate that you give up some of your electricity during peak times.
But it makes perfect sense. But and then utilization of technology to better utilize the infrastructure that's in. And I was talking to a gentleman, about 8 weeks ago. He worked for Pacific Gas and Electric designing energy systems. Like, he just designs energy systems. And I said tell me what that's like. And he said, well, the need today is growing so fast that the infrastructure to support it
Can't sustain.
It won't sustain unless there's some dramatic new technologies. And even then, they think it can't. So the interesting thing about electricity versus almost everything else you consume is it's really difficult and expensive to actually store. So I went to Iceland a year and a half ago. The number one export from Iceland is aluminum. Number one or number two. You guys can Google it if you want. It was
Okay.
it was seafood
export.
products, so it sits there. And I'm like, why aluminum? They import all the raw materials to make aluminum, but aluminum is so energy intensive that's what they decided to do because they've got so much hydropower and
Thermal.
And I thought, well, this is pretty brilliant. The place that actually has excess aluminum can't really ship it, or excess energy can't really ship it. It's not. You got to own yourself.
So they said, what is highly energy consuming, and can we produce that here?
Yes, and even though it takes us to import.
What's this all mean from an investor standpoint? Right, so people tune into our program because
it's investor.
I mean,
well, don't get overly excited about these AI stocks because there are headwinds. There will be headwinds. In fact, just building the server farms is not cheap.
And if you own an index, a stock S&P 500 fund, a total stock market fund,
you own it.
You own it.
You own quite a bit of it now,
That's right.
actually.
Yeah, as it's grown.
Yes, quite a bit of it. Probably a lot more than you actually realize.
Some of these companies are already priced to perfection. If you want to, because what happens, Pat, is you know this is what happens. There's that fear of missing out.
Yeah.
This is what happens in all cycles. Right now, it's AI. Next time, it's going to be something different, right? There's always a few companies that do extremely well. The stock price is up so high. And investors think, well, shoot, I missed out on that opportunity. But yet my neighbor, my bunco friend, my golf buddy, whatever, is sitting there telling me about how much money they've made on this particular stock. And then you start feeling foolish because you've missed out. Then you think maybe I should jump in and buy some because maybe it's going to keep going higher.
They don't talk about their losers, though. No one ever talks about their losers, the things they lost money on. They only talk about the winners.
And it's important that you make over the long cycle, not just. I'll never forget, Pat. It was the Y2K. We had a Y2K party at our house, right? And remember why are you laughing? It was a pretty big party. Like I don't know.
You had it on New Year's Eve?
Yeah, like I don't know, 80 people or something, 100 people maybe. We had a big party. Y2K. World's coming to an end.
This is the one where one of your friends turned the electricity off.
Yes, that's right. My buddy Dan, he lived 3 doors down, and right when we counted down, he'd flip the power off.
Which wasn't even that funny.
It was kind of funny because that's what everyone's expecting to happen. But considering the time zone on the West Coast after the globe, we've kind of seen that the world was actually going to continue to spin. But the reason I brought this up, there was a woman at the party. And as investment advisors, this happens to us. We'll be out somewhere, and someone want to show how smart they are, and we'll talk about some investments they've owned or something they've done investment-wise, just to show that they're worthy people or something.
Whatever.
And so this woman told me, she says, I am the proud owner, that's how she just started. I am the proud owner of Oracle, Lucent, and some other company.
Okay, so this is the end of 1999.
The very top.
And she had recently just purchased.
Of course.
Recently
I don't think she had bought him 8 years prior.
Right.
So maybe it was Qualcomm.
So what
I remember the ones.
So what happened to those stocks? I remember
they were
Lucent
destroyed.
Lucent was
Oracle's
down.
Still around and doing fine,
but Lucent was down 90%.
She would have been much better off had she just had money in the S&P 500,
an index fund
diversified.
Going out. Yeah, this fear of missing out is real.
Yeah, so don't get too caught up in this stuff, and to think that somehow you're going to be able to outsmart the market by
somehow.
Somehow. But that's what a lot of people are dealing with right now.
Yeah.
Or if they're in an investment club because in their community they live in, and
Well, remember that investment book that actually came out in the 90s, which was started if
Are
you're
these grandmas you're talking about?
correct. So, and there was a whole book written
What was the
on
name
this.
of that book?
Oh, it was something the investment, and they had done so really, really well.
Yeah, this was in the 90s.
Right. So
Yeah.
if you're a young listener of this,
what was that?
you're a young listener of this thing. So they used to have these investment clubs, and it was
They're
all
really popular in the 90s.
The rage, right? So we have a community out at Sun City, Roseville. There's Sun Cities all over the U.S., but it was called Del Webb, Sun City, Roseville. They would ask us if we wanted to come out and speak to the investment club. We're like, well, what do you want us to talk about? Well, we want you to talk about these individual stocks. We're like, we're not that excited. Well, this book kind of started all the craze. And the problem...
Beardstown?
Yeah, it was called something like that. The Beardstown's Ladies
I think
Club or
that's what it
something.
was. Was it Beardstown?
But after the book came out, they realized a year later that they hadn't. They hadn't. Do you remember this?
I forget what happened. There's accounting error.
They were making monthly deposits, and they weren't including that in the original capital. That's just the money they started with. So their returns look fabulous.
It was a long time after people were buying the book, right? They were
And then they started, and they were like,
interviewed.
Oh, yes. And they were interviewed, and then all of a sudden someone said, hey, the accounting, and then they all went to work for Enron. So it is, later on in the show.
And I'm not here to pick on women investors by any means.
Oh, no.
It's just a group of people getting around.
Oh, actually, I think women investors are, quite frankly, often
better than men.
Yes. Yeah. I think it has a lot
Look at some of the studies.
Yes. The studies will say that. And my own personal experience is that they have a tendency to be a little more patient and less ego-driven.
I would agree with that.
That's
a broad statement.
That's in my meeting with hundreds. But later on in the show, I do want to talk a little bit about this GameStop again. We talked about it a few weeks ago when Hello Kitty came out. But
Roaring Kitty.
Oh, Hello Kitty is. Hello Kitty is an anime.
Not too far off though.
Roaring Kitty.
It looks pretty odd too. Anyway,
oh, all right. But we're going to talk about that after we take some calls.
Yeah, let's take some calls here. If you would like to be a part of our program and have a financial question for us, we'd love to have you on the show. And to schedule a time to call us, just send us an email at questions@moneymatters.com. Again, questions@moneymatters.com. Or you can call us toll free 833-99-WORTH. I don't know why I said toll free. Like what toll? You look at your phone bill and wonder what your long distance toll charges are. Anyway, let's start off talking with Pat. Pat, you're with Allworth's Money Matters.
Hi, Scott and Pat. Great to talk with you this morning.
Thank you.
I guess I could start with my question, right? Or do you want me to start with kind of the background?
Whatever you'd like.
Yeah,
what's your question?
We got time. You seem like a nice enough guy. It's a podcast.
So,
you can run as long as we want.
Yeah, you got all the time in the world, right? You can edit this too, right?
Well, I've got
so if you
lunch.
don't like what I say, you can just chop that part out.
Well, I have lunch in an hour and 30 minutes with a friend of mine, so
we tend not to edit our callers much unless you swear.
Yeah, we don't edit.
That's
right.
almost never happens. So.
Or you get too political. So go ahead and talk about Trump and Biden.
No, thank you. No,
all right,
thank you.
well, fire away. Give us the background any way you want to start.
Yeah. So, real quick background, financial history, if you will. So, I retired from the Air Force in 1996 at 41. I was enlisted for 10 years, an officer for 12. So, I retired as a captain. But so with a great pension of $24,000 a year. And but with a master's degree in software engineering, which I was able to leverage into a very good income and second career, which I'm still at 69, working as a consultant in software technology project management for public sector, state of California,
Perfect.
welfare projects and things like that.
Perfect.
So I've got a good income of let's see, last year the AGI was like 267.
All right.
So my wife's a stay-at-home mom, always has been, except for a very few parts. So she's 4 years younger than me. Her full retirement age will be sometime toward the end of next year or so. And but I will hit 70, next April, And so that's the point at which I plan on taking Social Security and that kind of thing.
Okay.
Which she'll, so financially though, I had, I don't know, a few dollars, right, in the bank in a retirement account when I retired from the Air Force. But I made good money and got up a ways, a couple $100,000, and then hit the financial crisis. All that time, I'm just basically, in a 401k or in an IRA and kind of managing things myself. But in 2010, after kind of weathering the storm through the financial crisis, a friend of mine, he said, "Hey, I got this great friend who's a financial advisor, and you should sign up with him." And so I signed up with him. He gave me some advice. I had the portion of my investments that was, I don't remember, maybe 200,000 or so in an IRA, and then I had another 300,000 or 400,000 or something like that in my 401k with my company. So I was able to give my IRA to him to manage, and he did fine with it for 4 or 5 years. And I saw it go up, whereas, of course, during the financial crisis, things were not all that great.
Okay.
But he got kind of squirrely on me in that they started doing these, and they were managed. When I say financial advisor, so he was a fiduciary. And that's kind of I mentioned this part of it because that's sort of the core of my question about financial advising and what's the best strategy and what are the pros and cons with the different approaches. But the cost was pretty high. It was like 2.25%.
And when you said
of the portfolio.
When you said he got squirrely,
what happened?
What happened?
Oh, yeah. Sorry. I didn't finish that sentence, did I? So they started some kind of a deal where they were buying and selling individual stocks like on a weekly basis. Like one day of the week they'd buy, another day of the week they'd sell and this and that. And one of the things I have to do for my work is I have to report on a Form 700 to the state of California every year. All of my positions.
Not an appropriate investment strategy for you.
Yep.
Sound like you had what?
Let's disclose I got 50 different stock buys and all of this kind of stuff, and it just looked terrible. Plus, it really wasn't. It wasn't doing any better.
Of course not. Didn't your advisor understand the limitations you had? It sounds like you had what's called. It sounds like you had what was called, and they still call it a separately managed account. And this is where, let's say a professional money manager manages mutual funds, maybe pension plans, manages them. So they've got a team of analysts. They decide what stocks we should buy, when we should sell those stocks, and they might have hundreds of millions or billions of dollars in their mutual fund, but they also might have several hundred or several thousand individual clients that they manage what are called separately managed accounts. And
which are essentially unbundled mutual funds where you can actually see into them.
And the fees historically they're higher. And historically they used to be quite high. Like, so when you said 2.25 and those trades, my guess is that was what's called a separately managed account.
That's right. And they may have been using some market timing in there, but at this level, at 200,000 he was managing there inside of an IRA, I wouldn't see any.
Yeah, I mean, sometimes a separately managed account might make sense, and maybe a taxable account for a certain portion of one's income. But
inside of an IRA, it typically isn't less expensive. It's more expensive, and it adds no value inside of an IRA. As Scott said, in a taxable account, you can make the argument. And I make the argument that you should, in points in time, especially if it's what we call fresh money that someone just sold a business and they haven't invested any of it, that you can mimic the S&P 500 with about 80 stocks.
Yeah, either a little more than that, but synthetic index, or individual securities as opposed to an index or a mutual fund. I'm saying because. The tax strategies.
Yeah, you can harvest tax losses. And it's not designed to actually give you excess returns. These separately managed accounts are typically just designed in order for tax strategy. So you got someone, when you said the word squirrely, you were right. I mean, why go through all that pain and suffering for nothing?
Yeah, that was the bottom line. Is it wasn't really making a lot of money or anything like that. So it was odd. So kind of fast forward to today. I left the company that I'd been working for 15 years, a small local consulting firm. I went on my own. I have my own contracts with the state of California. But all through that, the company I worked for and on my own, I was able to contribute significantly to my then 401k, now a SEP IRA, $50K plus or so a year.
How much?
So now I'm sitting at $3 million in my retirement accounts between my SEP IRA and my rollover IRA.
And how much money is outside of qualified plans?
Oh, I've only got like 100,000 or so in a brokerage account.
How much longer do you plan on working?
Yeah, so I have a contract that goes about 2.5 more years, but at halftime. I have two contracts now. One is halftime through next April, and then the other one is halftime with a different department, but similar kinds of Medicaid projects.
Got it. So you're
another 2 or 3 years.
You're installing some Oracle or SAP system, and that it's supposed to be done at that.
No, not quite that. These are like welfare, like Medicaid projects. Like it's a software system they use to manage cases.
Got it.
That kind of thing. It's more enterprise resource management.
Got it.
Kinds of financials and case management. Who's eligible for services?
Here's what Pat. You how much are you living on?
Well. We have 4 kids and 9 grandkids, and we are generous individuals.
Okay.
At least my wife is, and I try to keep up with her. She sets the pace, and I'm on board, funding her generosity.
Well, and the reason I asked that question is you could defer a lot more of your income if you wanted to, above the self-employed 401k limits. But
yeah.
Yeah,
but I'm not able to.
But you're living on. You said you make $267,000 a year.
Well, that was the AGI.
I think, Pat, if there was $1 million in a brokerage account, then you might say, what if we set up an age-based pension plan? Maybe we even use a Roth portion of it.
That's why I was trying to figure out how much money we shovel in. But it's so. What's your question for us?
Yeah. So I fired the advisor in 2016, and I've been muddling along on my own, paying attention, not paying attention, things like that, up and down. Things, of course, it's been a great last year, so things are going well. But I can look at the chart. I do have a financial plan in that I have a very big and complicated spreadsheet of when I'm going to start Social Security and how much I need to take out of this account or that account when I start drawing RMDs and those kinds of things, and where my retirement pension is at this point, and how much Social Security is going to be, et cetera, et cetera. So I've kind of got that in place, but I'm still kind of wrestling with do I want to continue to manage my assets going forward as I actually do go into retirement and stop working? Do I want to go with the business? I'm not using the right term. The institution where I have my money is one of those big, brokerage.
Yeah, like Charles Schwab or Fidelity or
letter F.
Right? Yeah, it's a Fidelity.
Yeah. And they, because I guess, lo and behold, somewhere along the line, they said, well, hey, given the amount of money you have,
let us refer you to an advisor.
Let us refer you to an advisor, right?
Yeah, and so then I have a guy that I meet with every, 6 months or so.
Is he
the financial consultant at Fidelity?
Pat, does he work at Fidelity or does he work at a third party?
No, he works at Fidelity, but he's not a fiduciary because he's saying that he's recommending their fiduciary services.
Let me step in. Let me step in if you don't mind. A couple things. First of all, if you look at the data, as people's net worth increases, they're much more likely to have a financial advisor for a couple reasons. One, sometimes people see their own need. Like I struggle in some areas. I'm much better off having an advisor. But secondly, as one's assets grow, oftentimes people say, you know what? I would just like to outsource this and not worry about this and let someone else deal with it. I can afford to pay an advisor. I've got plenty of money. I'm going to hire an advisor, and I'm going to forget about all this stuff. And so,
I know it's going to happen in my lifetime.
Well,
I know it's going to happen in my life, and I'm a financial advisor.
Me too. And further, oftentimes there's a time in life where people say, I need an advisor here that my spouse knows and trusts.
That's the biggest thing.
Because I'm not going to be here forever. Odds are I'm going to predecease my spouse, and I want to make sure there's someone there.
And your spouse is, based on what you said, you didn't say her age, but she appears to be 4 or 5 years younger, right?
Yeah, almost exactly 4 years younger.
Okay.
2 days apart is our birthdays.
Okay,
Yeah.
So what's happened with these large firms, Fidelity, Schwab? So they have their own team of financial consultants, right, in the branches or on a 1-800 line that are sometimes they're quite knowledgeable individuals, certified financial planners at times and stuff. They are not independent fiduciaries, right? So they've got their own conflicts they live within because Fidelity's manufactured products, they offer custodian, they do just about everything in financial services. But these large firms have realized that as their clients' assets get larger and the more complex, their need for more in-depth financial planning grows, and rather than them trying to provide it all in-house, they partner with independent advisors.
Including firms like us.
Yeah, that's right.
So
full disclosure, yeah.
We Fidelity sends us business, and in return, they take a percentage of whatever the fees that we actually charge the client. We still act as a fiduciary, and we're allowed to do that as long as it's disclosed to the client that, in fact, there is some fee. So Fidelity, when they look at it, it's actually brilliant. I mean, it is a brilliant business model because they're actually serving a need in the marketplace that they aren't. But by the way, we come back here 20 years from now. My guess is Fidelity will actually have divisions in their company that act as our
maybe, yeah.
Who knows?
Whatever. But that's where we are today.
But that's where we're at today. So you're ready for a financial advisor. The mere fact that you actually called and the experience that you had with the last advisor won't be anything like that.
The advantage you would receive from one of these firms, Fidelity, Schwab, or whatever, they'll typically refer you to a few different advisors. They've all been vetted. Right, so they tend to be pretty high quality advisors. They've been vetted by these companies because Fidelity's names, their reputation's on the line here, and they want to make sure that they're good advisors. So, it sounds like the experience you had before with this other advisor, you're not going to run into that same kind of experience.
Yeah, that's tough.
But one thing you might want to do is the next few months just interview some advisors and say,
take the list.
If I were a client, what would you do? Give me an idea, how you would structure this.
Yeah.
And then you could decide, at some point in time, you'll hire an advisor, whether it's this year or next year or 5 years. At some point, you're going to hire it. And you're going to want someone, even if, ready to go in case you have some health issue or something.
And there's this big push to go remote. You want an advisor, if at all possible, that you could actually sit down with when things get tough, when there's a death in the family or the home needs to be sold or you're going into a care facility, all of those things, there is an emotional attachment to that money. And if you could do it in person, it's better for both the advisor and you. Just flat out.
So I get the idea that what you're saying is that so they're pushing something on me or toward me. They're asking me to consider what they call their managed services, where they say it's a fiduciary. They say they manage the assets for me. They didn't talk at all about a truly independent advisor. And it sounds like the services that you're talking about are beyond what just managing the money.
Oh, absolutely. Yeah.
Tax planning, estate planning.
Yes.
Tax preparation.
And they've got all different price points and layers inside of Fidelity. And they may actually be pushing you to someone internally. But look, this is enough money. You've done well enough. You could hire a real advisor. Just ask them, hey, can you refer me to a local advisor? And they'll give you a list. Yep. Easy enough. Appreciate the call.
Yeah,
and thank you, by the way, for your service.
And there are a lot of people that are competent with their own finances and hire an advisor as they get later in life Well, I remember one time a gentleman that I knew came to me and he said he's on a medication. He was 71 or so. His doctor put him on some medication. I forget what it was for, but the doctor said, "Look, this medication it's going to mess with your ability to make sound decisions. You should not be making financial decisions on your own anymore," which would be a tough thing to hear from your doctor, right? There's clearly a time to hire an advisor, but oftentimes if there's only one of the spouses that's involved in the finances,
most certainly,
you get another advisor involved, and it could be helpful. So
most certainly.
Let's appreciate the call, Pat. Let's turn now. We're going to go to North Carolina, talk with Tom. Tom, you're with Allworth Money Matters.
Hey guys, how's it going?
We're doing fantastic.
Really appreciate your show, and it's a privilege to talk to you guys. I have a question. I'm been retired for about a year and a half, although my wife is continuing to work. We're both 57s.
All right.
And if I may, I'd give you a kind of a
Please.
snapshot of our overall assets. Pre-tax, $1.8 million. Roth or tax-free, $1.8. Brokerage, $800K. We also have 2 homes right now, both paid off. So our net worth is about $5.6 million, and getting to the first big decision in retirement. And I've looked at it in a number of ways, and I'd like your opinion on that. And the decision is, should we buy another house down in Florida, where we spent a number of years, months at a time. We really like the area, and we're looking at a potential purchase of a $500,000 house on that.
Okay, and you said you own 2 homes already.
Right.
Are you consuming both those homes? Is one a vacation home and one you live in, or is one a rental, or?
Yeah, we're consuming both.
Okay.
We don't rent either out. In fact, my son is in what I'll call the mountain house now.
Okay.
He's going to school in Western North Carolina.
Got it.
And then we have the city house where we live. And the idea is maybe in 3 to 4 years we would sell this particular house, but
The city house.
we've been looking. Yeah, the city house, right?
Okay.
So we've been looking down in Florida, and, as I kind of piece this together, there would be a 2 or 3 year period where we'd be carrying 3 houses.
Okay.
Which I don't like, but
What income sources do you have?
so I'm retired. My wife is still working. She's at about $100K a year.
Mm-hmm.
So we've been kind of back and forth from North Carolina down to Florida. Every time we see a house we like, we go down and check it out.
And you receive no pension.
No pension.
All right. And is the reason that you're not selling is it your son is staying in what you called the mountain house, which sounds beautiful, by the way.
Yeah.
In North Carolina,
In North Carolina.
I've been to North Carolina only a few times. I think it's a lovely state.
Is the reason you're not doing this now is because your son is living in the mountain house? Because why are you waiting? Why wouldn't you just sell the house you're in now and buy the house in Florida and spend your time between? You said you're going to do it in 3 years. What are you waiting for?
His wife still works.
Well, that would make a lot of sense, right? To go down to 2 houses. Well, my daughter's still here.
Okay.
And she's in university, and she'll be graduating in 2 years.
And your
3
son,
if she.
And your son is staying at the mountain house, and you don't want to stay up there with him.
The mountain house is sort of like a legacy place.
Okay. Are you taking any income from that brokerage account, dividends, or do you tap into it?
No, not so far. 18 months in, and we're kind of living off of what we had in the bank and her salary.
And what's the city house worth?
$750.
Okay, so if the plan is take $500,000 from the brokerage account, buy a house in Florida, 3 years from now, roughly, sell the city house, as you call it, and move to Florida, I don't see any problem with it.
I don't see, other than that you've got market risk in that trade right now.
Yeah, but
And you've got the hassle of actually owning 3 houses. But
Tom's retired. Give him something to do. He can go.
Yeah. No,
Yeah,
I agree with Scott. There's the inherent risk or market risk in the real estate market.
And how much longer is your wife planning on working?
Yeah, she'll probably go. Probably 2 to 3 years, I guess, is the answer.
So if you're asking us to opine on that, I think you'd be okay.
Yeah.
Yeah,
I mean,
you've
you've increased, you've got an additional element of risk here and additional expenses, obviously, with insurance and whatnot. And the risk is to what Pat had mentioned, that let's say the real estate market is in the doldrums
when you go to
want
sell
and
you bought at a higher valuation and you sell at a lower valuation, but the spread there is $250,000. So I think that you could actually take that risk.
Yep, I would agree.
Right. And then the other risk is just the carry risk, which is now I'm carrying 3 houses. And the only
I'm
thing
a little bit concerned about, the overall withdrawal rate goes up if I can try to finance part of this house, which would be.
What's the point?
Why would you finance part of it?
What's the point? There's no point in financing part of it. Just use whatever's in the brokerage account. How much gain do you have embedded in the brokerage?
There's probably 50% gain in that number.
All right. Well, then you might want to finance some of it. I mean, that's an analysis you'd have to do, right?
What was your income when you were in the marketplace?
250.
Yeah. So I mean, when I started looking at the numbers, I'm thinking, let's assume your wife quit working today. I mean, we could can pretty much replace her salary, but you're not going to get back to where you once were.
Yeah, you said, look, in the perfect world, you would not carry 3 houses on the books at any point in time. That's just flat it.
Right.
You would sell one and buy the other, and in fact you'd sell the one you're in, and then you wouldn't buy the new one until the other one is sold.
Sure. Yeah.
Right. And so you can swing it, but there's inherent risk in this that you may or may not want to take. And quite frankly, if you were sitting in my office, I'd say, I don't understand what the hurry is.
Well, whether it's today or in 2 years, we're only going to buy if this house in Florida checks all the boxes.
Understand?
But,
this will set you back in retirement income because you've just taken some money out. That whether it's a loan, I mean,
I would.
And I certainly wouldn't want to pay 7% on money to go buy a.
Yeah, I wouldn't. I'd say you can do it, but it wouldn't. I would wait until the stars are perfectly aligned. And then in
terms of source of funds, we've talked about the brokerage account, which I guess is kind of the default. But
is there no cash in there?
I've done the analysis where can I take some out? Well, rule of 55, I can take out some 401k for this as well, but because eventually that's going to have to be converted to more raw.
When the rule of 55,
he was 55 when he left.
Oh, got it.
That means I just have access.
Yeah, no, I understand.
I understand.
Oh, yeah, I absolutely understand. That isn't the issue.
I think my concern is, like, a couple of years ago, you had a household income of $350,000.
Now it's 100.
Yep.
And you want to actually increase your expenses.
Yes.
And what I'm saying is, look, you're 57. Don't buy the house in Florida until you sell the city house. Just flat out. Just don't.
I would agree with that.
Just don't do it. And look, you'd say, well, I could do this and this and this. I've seen it work and I've seen it not work. Right? And
there's a big risk. Right?
Yeah, you'll be fine. Why take the risk? Heck, the hard part is done. You're 57. You're retired. Right? Just wait.
I think that and when we say the impact it would have on the family finances,
if it went bad,
could be significant.
If it went bad.
That's right. It really could be.
Yeah. And not only that, You think you're going to go down to buy a house in Florida and you're just going to let it sit? You're going to be in there. You're going to be repainting it. Let's rip this wall. Your wife's going to
furnish
the
it.
bathroom, this, that. You've got 3 assets you're sitting on. You've seen the
Pay
movie.
for insurance.
You've seen the movie.
I figure it's $50,000 a year to hold that house.
That's why you wait. Because you can't afford both the city and that for any period of time. I'd wait.
Okay.
All
right. Very good.
Yeah. Hey, glad you called, Tom. Yeah, it's always.
I appreciate your time.
Yeah, no, it's good. When you're wise for getting another opinion, maybe you want to get another opinion after us as well. But I think it's prudent, particularly before you do something along those lines, to run it by somebody.
Well, yeah, it's the problem is that the income will go from $350,000 to zero in a relatively short period of time, and it sounds like a lot. You know, when you add up the money, it's like, well, there's $3.6 million in IRAs and Roth IRAs, and then there's another $800,000 in brokerage. So we're at like $4.5 million, but you're replacing $350,000 a year in income. So we're looking at an 8% distribution to replace all of it, which is too high for a 57-year-old.
Yeah, for sure. And let's go to California and talk with Jana. Jana, you're with Allworth Money Matters.
Hi, thanks for taking my call.
Yeah.
I was checking to see what your guys' opinion is. My mom's getting to a situation where she needs to move in with my husband and I, and we would like to sell her mobile home that she lives in. I'm wondering what we should do with the proceeds of the mobile home sale, and we kind of want to save it. I'm thinking we need to save it for in case she needs to be in a memory care facility in the future. But I don't know if there's like any tax implications or anything like that.
There are none, and you were right.
Okay. Well, that was easy.
I mean, how old's your mom?
76.
So it's relatively young.
And the value?
Since it's a mobile home, the value is about $200,000. She has some credit cards we need to pay off. I think she'll have about 175, 150 when we're all done.
And she didn't have anything else?
Nope. Mm-mm.
I would agree with you.
Yep.
I just put it in a
high yield savings account. Yep. Are there any other children Are there any other children in the family?
Yeah, it's me and my sister.
Okay, so put it in your mom's name and then put a TOD on the account.
Well, you might want a limited power of attorney.
Well, that is as well.
Yeah.
Yeah.
Okay.
Do you have a limited power of attorney?
Not yet, and
Okay.
that's one thing. She doesn't have a will.
She didn't need a will.
We got to fix all this. She
doesn't-
doesn't need one.
No.
Okay.
I mean, this is the only asset she has, correct?
Yes, the only other thing she has is a brokerage account.
And how much is in the brokerage account?
About 150.
Oh.
So
She should have a
she'll end
will.
up with maybe 300.
I mean, you could set both those up in what's called a transfer at death or payable on death, where it's kind of like a beneficiary. Both you and your sister can be listed on there and avoids probate. It's nice, clean, and simple. Which is, frankly, that's how. If this was my mother, that's how I would.
That's
set
right.
it up.
I wouldn't go through.
That's your.
getting
And
the-
I'm saying that.
to get a
But
trust,
having
but-
things like an advanced health care directive, I don't know if she's got
Most
that
certainly.
in place yet, and some power of
Okay.
attorneys, which you get typically through the estate planning process.
Yes. But you don't have to get a
Okay.
trust to get a power of
No,
attorney.
of course. No, I don't think she needs a trust.
Yeah. So TOD, transfer on death to your sister. So both those accounts, right, need to be what are called TOD, transfer on death, and then a power of attorney.
Okay.
And obviously healthcare
Yeah, because I don't
directives.
think she'll be mentally capable within the next few years.
That's
You want to do it now.
Right. That's why we're doing this. I
Yeah.
literally just bought a home. It's big enough so she can come live with
God
us.
bless you.
We're going to sell her a place, have her move in with us.
That's amazing.
I'm fortunate to be able to do this. I'm
That's
very
nice.
fortunate. I'm very fortunate my husband's willing as well.
I was almost said something, but yeah.
I don't know how I'd feel. I love your mom, but I don't want her moving in with me.
Well, that's why we bought another home. She has like her own separate entrance.
Oh,
It's
perfect.
like her own space.
Oh,
There's some
that's
thought.
great.
Oh, perfect. Good for you. Good for you. Good for you. Yep.
Yeah.
So easy. Just do the TODs and then the other appropriate paperwork.
Okay, and then I was thinking maybe do you think a high yield savings, or should we try to invest it in
No, high yield savings. That's all you want.
high yield?
Yeah, something that's
I mean-
completely cash.
She's got three. $300,000. If she ends up needing care somewhere, it's, as you know, it's very expensive, right?
Yes.
Yeah. So if this were my mother, I would have it just in
healthy
cash.
otherwise.
Yes.
Okay.
Yeah.
Okay. I just wasn't sure about like a growth stock mutual fund or anything like that.
Well, you might want to look at what's in that brokerage account and see how that's invested.
Okay. That I don't have access to, but I will work on that.
Yep.
And see what we can find out.
So I would, and maybe when the dust settles, maybe you take some portion and allocate it towards the longer term.
But let the dust settle.
But any money that you might need within 5 years, you want it in cash, high yield savings account.
Yeah.
And that's why I'm thinking, you say she's got some memory issues now. If things get worse and suddenly it's 24 months from now and you're like, this isn't work, we can't sustain this, then suddenly she's in a memory care center. It's pretty expensive. So you wouldn't, the worst thing to do is you invest all these dollars and suddenly we need it in 24 months and it's worth less than what we put into it and we got to sell it at a loss.
Yeah, I don't want to do that.
No,
either.
I know. They wouldn't want to do that.
Yeah. Okay.
All right.
Blessings to you. Wish you well. Yes. Thank you.
All right. Thank you for your help.
Thanks. Actually, I could have had my mother-in-law live with us. She passed away quite young, but relatively young. But
I won't.
She was not going to comment.
My mother-in-law passed away a number of years ago, but I will not comment.
Mine was like the.
Oh, your mother-in-law was great.
I couldn't. I mean, she was unbelievable.
She would make you special.
She was vegetarian,
but would cook you steak.
Meatloaf, yes, and steak. Meatloaf with different meats all mixed together and stuff.
Well, that's how you make meatloaf, Scott.
I've never made meatloaf.
That's how you make it.
Well, that's what she did for me.
Yeah, and would she clean the house too and come over to do the dishes?
She would help with the dishes. So I never had. She cleaned the house.
She wax your car.
No, but she was a phenomenal grandmother to my kids.
Yes.
She was never once told me how to be a parent or a husband. Never once. Was always so respectful of my space. Wanted to make sure my wife and I had dates and stuff and all that. She would have been really easy to live with. And maybe she would have continued to make me meatloaf. Because my wife doesn't cook much, so.
And that's what we miss most about her.
Oh, I do miss Betty.
She was a nice lady.
Hey, Pat, I want to.
Wait, Scott, but before,
Go ahead.
I said that at the beginning of the show, let's talk briefly. No, actually, you're going to promote.
I'm going to promote a webinar.
Then I'm going to talk briefly. Give me a minute or two to talk briefly about GameStop.
Of course. But this is, look, we've got it's a free Allworth webinar that I think is beneficial, and I'll tell you why in a moment. But it's really details how investors should think about politics, the markets, and your finances. This election year, right? We're in an election year. People are concerned about what's going on with the election for a variety of reasons, understandably so. And invariably, come November 7th, the day after the election, we will have phone calls from people, regardless of who wins, saying, get me out of the market. I can't believe this guy won. My life's going to be terrible. So what this webinar does is it looks through a lot of history on what's happened when different people were in office. And I sat down with, actually we stood up for this whole thing, with Apollo Lopescu. And Apollo is a well-known investment manager at Dimensional Fund Advisors. He's considered the secretary of explaining stuff. He's got an uncanny way of taking complex financial topics and putting them into ways that individuals without much financial knowledge can understand. And so I had actually first met Apollo at a different conference, and after hearing him speak, I'm like, I need to interview this guy and put some education materials for.
You went to Austin to do this,
Austin,
did you
Texas,
not?
yeah, where we did this. So, in the conversation that we're going to highlight how you need to think about your money in an election year. So, we're going to look at election year market performance. We're going to look at the political parties when they're in power, the past, how things have done over that time. And we're going to look at some smart investment planning, that sort of thing. But the webinars are going to be broadcast Thursday, June 20th and Saturday, June 22nd. Again, Thursday, June 20th, Saturday, June 22nd. I think you'll find them both informative, educational, and entertaining.
And this is an interview with you. That's the whole thing, with him and you just talking.
talking, and he has a really unique communication style where he draws stuff out that will be on the screen.
Well, perfect.
No, it's really good.
I'm actually going to
That's good. I mean, the guy's fascinating. He explains things like no one else. Allworthfinancial.com/workshops will get you all the details and to register for that.
And while you're there, sign up for our newsletter.
Yeah.
So before we go, Scott, this GameStop, I don't know why I'm fascinated by this stuff. And I just think it's because it's a bizarre human behavior. And we talked about it earlier, this fear of missing out or people that think they're going to do this. So GameStop, this Roaring Kitty, he actually took a position. And then once he takes the position, he takes a $260 million in shares and options contracts.
He's a big option guy.
Right? $260 million personally, right, in options. He goes on and he starts posting on X. The market cap right now of GameStop is $10.7 billion, and it's got a price to earnings ratio as of this morning, 1,596. So for every dollar of earnings that you're buying, that stock trades for almost 1,600 times that. Like, this is the equivalent of buying a small AM/PM in terms of its earnings and paying $1,600
$1 billion for it.
Not a Arco, but a single. It's the craziest thing.
Well, when you bring up AM/PM, it's a good way to kind of think about things, right? Like, is that a good investment? It all depends on what you have to pay for it.
That's right.
If the AM/PM costs you $1 to buy the AM/PM,
Great investment.
If it costs you $1 billion, horrible investment.
1,600 times. Don't play in this
It's crazy.
this sandbox.
It's crazy. Anyway, we are out of time for this week's
Thanks
program.
for joining us. And if you've liked the podcast at all, please go online and give us a rating and a thumbs up and share with a friend.
This has been Scott Hansen and Pat McClain of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.